Ladies and gentlemen, welcome back to the channel. This might be the most important video you guys ever see from me. Why do I say that? Because I have been talking about religiously here on this channel almost every single day, if not every single week, for 4, 5, 6 months now, that we have to see the markets coming down in order to see the MOASS. That was not a very light topic. Now people are starting to actually realize that is the case. You're going to see short-term pain with AMC and the broad markets, and then you're going to see AMC rise from the ashes once the markets are down in the dirt. After the dust settles, that's when AMC is going to start making its monstrous rally to the upside, just like all throughout 2008 with Volkswagen, with Overstock, with all of the other short squeeze trades at that time. It's the similar concept that we need to see with AMC. But here in this video, I want to go over some very alarming signs that I am seeing for the broad economy for when the markets are actually going to come down and just how aggressively this is going to be. And I think I'm going to shock a lot of you guys. So I highly recommend you guys spread this video, push it out to people, even people that aren't necessarily invested in the stock market may get a lot of value out of this video. So let's dive into it. So first things first, why exactly are the markets selling off? Because that's going to give us the timeline to go off of as far as when the markets could see a bottom. Because forget Jim Cramer, forget the other analysts that are saying the bottom is now. That's not the case. We just had the worst week since the crash of 2020. Look at this. It looks almost identical to what we seen during the crash of 2020, which was a very brutal time, but very exciting and full of opportunities nevertheless. So why is the market really selling off? It's not what the analysts are saying. It's not because the Fed and the markets just all of a sudden realize, hey, the Fed might start being super hawkish. We've known about that for at least a month now. It's not because inflation is super high. We've known about that for 6 months. We've been expecting that for 2 years. It didn't just flip a switch and start selling off like this because of things we have already known about. With that being said, why are the markets really selling off? And it comes down to stimulus or lack of stimulus, because this whole move was propped up on funny money. You can't just give people money they did not work for free and expect them not to spend it at these companies to artificially prop up the valuations and earnings of said companies. You have to imagine that most of that money went to Apple, Tesla, Nvidia, Amazon, Google, all of your top stocks that control the indexes. We are starting to see spending slowing down. So in my mind, with no stimulus, then earnings have to come down substantially. And that's what you're going to see. And it is going to be brutally ugly to look at the earnings from 2020 and 2021 at, say, your largest company in the world that accounts for 12% of the NASDAQ, Apple, in 2022 compared to the last 2 years. It is going to be horrible. You're talking about possibly a 20-25% revenue slowdown, if not more than that, because people just don't have disposable money. People are waiting to get that new iPhone. They're waiting to get AirPods or iPads or Apple Plus subscription. They're waiting to do these things because they simply don't have the money. And we got the first sign of that. That was the December retail sales were down 1.9%. The estimate was 0.1%. So we missed that estimate by 19x, excuse me. It was supposed to be 0.1% to the negative. It was 1.19% to the negative. We missed that by 19x. We were way off with our calculation. So that sent the algorithms into a bit of a frenzy. And now we're starting to see Netflix, the first big tech company, miss their earnings. So that is really the snowball that is going to start this massive correction into a bear market, possibly looking at a 30 to 40% decline in the indexes. Now, if you're saying to yourself, we already have seen that, the markets are in a bear market. Well, technically, they're not. The NASDAQ is down about 15% from its highs, so we're approaching a bear market, but the markets don't look nearly as bad when you're looking at the NASDAQ or the S&P than what they truly are. And I will be the first one to tell you and be transparent with you. I am down 26% in the last 3 months. And I've been hitting monstrous hedge trades almost every single day. So I would be down much more than that if I was not actually hedging out my positions and hedging out my portfolio. If you guys want access to that, link down below in the pinned comment. But that is not the point. The markets are bloody. They are held up by your top stocks. And next week, we have the most important week that is going to either make or break the markets for the rest of the year. Keep in mind, if you guys have been subscribed to this channel for a while, I was calling out really Q1 2022 earnings to be the time where you do start to see that sell-off, which we are in Q4 2021 earnings. It's weird, it's delayed just a little bit. We're technically in Q1 right now, but we're getting the Q4 earnings, which are typically your strongest earnings. But I think we have some outrageously high expectations for Q4 earnings. And once these companies like Apple miss those earnings, you could see substantial moves to the downside, just like Netflix. If you've seen that at Apple, you could expect to see a 4 to 5% down day on your S&P and NASDAQs and send us straight into a bear market. And that's when liquidity will be restricted, especially when you're thinking about the AMC MOASS, because the hedge funds, they usually hedge out their portfolios with the NASDAQ, with the S&P, with your indexes, not necessarily with individual stocks, but with the indexes. So once they come down, that's really when you are primed to see the MOASS. And why am I saying this? How do I know spending is going to slow down dramatically, 20 or 30%, revenue at these companies like Apple? How do I know that? Am I just pulling that out of my ass? Well, take a look at the personal savings. This is crazy, to be honest with you guys. Look, right, this is 2019, about 8.2%, 9% back here in December 2018, go down to, never going under 7%. That is the percentage of income that people are saving every single year as far as how much they're actually making. You guys can see it right there. Units percent seasonally adjusted annual rate. So we are currently at 6.9%. That is lower than pre-COVID. That is substantially lower than pre-COVID. March 2019, we were sitting at almost 9%. That's a big difference, and that's a very, very big deal. You guys can see the big spikes, COVID related. Now we're back plummeting into the ground. And this is essentially your gauge of disposable money that people just can spend. Right? If you're spending money, it's usually from your savings to buy that iPhone or to buy that Xbox or PlayStation or whatever the hell else it is. It's coming from your savings. And that rate is plummeting into the ground. So there is not that much money left out there. And I know somebody is thinking when they hear this, and hear this thesis, well, we've printed like 25% of the money. How do people not have money? There must be extra money out there. Not always the case. When velocity of money is low, that means, for every dollar you get, it circulates around, usually before the pandemic was 5 times. Now it's sitting at about 2.5 times. So what that means is that once you acquire a dollar, it reaches its end goal about twice as fast as it used to. So if you get a dollar, that dollar goes to Apple, and then that dollar goes to a billionaire's bank account or whatever the hell else it is, something stable. You could take money out of the economy and it could be sitting in gold, silver, in somebody's bank account, in a new car, right? If everybody's buying these new cars with all of this money, that money kind of just evaporated and it ends up somewhere. It doesn't always go into the stock market. So that does not translate into seeing, more money into the stock market or even more long-term earnings at companies overall. We've already seen those earnings at the companies over the past 2 years from that funny money. Now it has settled down And even though we've printed that money, does not mean that you can expect to see a revenue boost at these companies. That's just flat out the truth. So hopefully that makes some sense, you guys. Hopefully you guys understand just how bad the situation actually is. And this is only the start. I honestly expect, Q4 2021 earnings to not be all that bad. It's not going to be up to investors' expectations, but they're not going to be terrible. You're going to get terrible earnings starting Q1, Q2, Q3, and Q4, basically all of 2022. And another added reason to this, because I am a content creator, I do get paid from YouTube. The ad revenues have dropped more than what I have ever seen. And I've known other creators, so on and so forth. And you've never seen a 40% revenue decline. That means for every 1,000 views, you get paid X amount. Now you're getting paid 40% less than that because advertisers are not spending as much money to get in front of you guys, the viewers. So usually you do see a drop off in your ad rates on YouTube from literally the 31st of December to January 1st. It goes down about 10 to 15%, not 40%. That means companies are advertising a lot less this year than they have in the recent history. In the, really the history of YouTube, I have not seen such a dramatic decline in the amount of money advertisers are spending. And that's the first thing that gets cut if your company is expecting lower revenue. You're not going to advertise as much because you can't afford to. That's not something you have to do. So when you add all of this together, not looking all too good. If you do take a look, the mortgage rates just hit their highest since March 2020, with the average rate being about 3.75%. I know I got a mortgage in 2021 earlier. Well, we're not in 2021 now, but around March of last year, got a mortgage, a rental property. That rental property, which rentals usually have a higher interest rate because they're deemed as a little bit more risky, that was 3.25%. So they are up substantially. So you're seeing housing slowing down. Not as many people are even buying houses. They're not really buying too much. Take a look at this Google Trends. We have the blue for the search term home loans and the red line for search term auto loans. And you're seeing a substantial sell-off from September 2021 straight down to the lowest levels that we have seen, lower than really, you have to go back to like 2015 to see the search rates for home loans and auto loans this low. Like, you have to go back almost 7 years to see the search terms this low. That's kind of crazy if you think about it like that. Like 2008 type, 2010 type, frequency of these terms being searched. Not a good sign. And when you're thinking about the stock market and fundamental valuations, it has to be accounted for. All of this has to be accounted for. And we are up way too much for it not to matter at this current moment. And then you add, on top of all of that, we have not even talked about inflation or the Fed. Add that in the scenario, oh man, the whole equation gets messed up. It looks even worse at that point. So when you add all of this together, it's not looking so hot in the markets for 2022. Now, if you're somebody like me and you have other stocks, not just AMC, I'm not 100% in AMC. If you are, fine, that is your choice. I am personally not, because I am a longer term investor as well as a trader as well. And I like to take advantage of all opportunities out there, whether it's to the downside or to the upside. So I've been trading this the whole time, and I've been making fat tendies. Hopefully, I know a lot of you guys are. If you're in the community, link down below in the pinned comment, you have also been doing very well for yourselves. There is also more that you can dive into, but all of it comes to the same conclusion, that spending is slowing down, that company earnings will not be as good as investors thought they would in 2022. Because after all, the last thing you want to see is the Fed tightening, high inflation, and earnings worse year over year. You don't want to see that. you at least want to see earnings better than the year before and the Fed tightening and higher inflation. That's a lot better than vice versa. So let's just go ahead and bottom line this. How far can the stock market actually go? Now, you could do some calculations here. I mean, you could take the price of the stock like what it was at before the crash of 2020. You could say, hey, in 2 years, the reasonable revenue increases minus all the funny money might be like 30%. So that would put you roughly in this range about right here at about $370 on the SPY. That would be a nice correction, and you would see a lot of pain in the markets, but you would see liquidity virtually being dried up. You would see margin calls on a massive scale. So I do think we could possibly go down to $370 to $375 on the SPY. What I would really bet on is probably about $400 on the SPY. That's still into a bear market, and you're still going to see the liquidity being constricted. Now, I think we will go lower than 400, but I'm not a fortune teller here, and I'm certainly not telling you guys to make trades based off of what I am saying. But when will this actually hit its peak? When will we see peak fear and see the bottom and ultimately be one catalyst away from seeing the MOASS and forcing shorts to cover? Well, I think it's going to be once the Fed makes their announcement next week. We'll get some kind of guidance from the Fed, and we will get Apple earnings. The Fed meeting is January 25th and the 26th, and then we do have Apple earnings the next day after Fed Jerome Powell makes his speech. So that is going to be very important. If all of that is hawkish, then I do expect a very violent sell-off. But once you start to see the markets actually fully pricing these things in, that's when you will see the bottom. And I do think this could be a type of situation where you do see a big drop, it rips up a little bit, it drops down further, rips up again, drops down further, and you slowly make your way down and down and down, sub $400 on the SPY. When I think that will actually happen is probably around April or May, once you start to get Q1 2022 earnings that are coming out. I think that's going to be the dagger in the coffin that's going to solidify exactly what I am saying here in this video about spending slowing down and the revenue at these companies slowing down as well, which will kill the valuations once and for all. So make sure to save this video. Check back in on it once the markets do actually start to hit their bottom and once we are sub $400 on the SPY. So hit that like button for me if you guys learned anything, if you guys found entertainment or just got some insight into what I am thinking and why I am saying this, as well as comment down below. Are you guys excited for this? We have been waiting for this for so long and it's finally here, and we're one catalyst away from the MOASS once this comes to fruition. So if you guys are excited, let me know down below in the comment section, as well as how many shares of AMC you guys currently own. As always, make sure to subscribe to the channel, and if you guys want to get totally free stock with Public, Webull, and Moomoo, links for those down below in the description of this video, as well as the link for the buy and sell alerts, as well as the link to follow me on Twitter in the pinned comment down below. Love and appreciate you guys. Enjoy your weekend. I will see you in the next one.